The great American pastime of picking individual stocks is slowly but surely fading into the background. For generations, the image of the savvy investor poring over charts and annual reports to find the next big winner was the very definition of building wealth. This was the hero's journey of finance. Yet today, fewer and fewer ordinary people are embarking on this perilous journey. They're realizing that trying to beat the market is a difficult, often losing proposition. The siren song of outsmarting Wall Street is being replaced by a more sensible, more humble tune. The truth is that the stock picker's game is a loser's game, not because it is impossible to win, but because the odds are so heavily stacked against you. You are competing against teams of the brightest minds in the world, armed with supercomputers. Two powerful forces are leading this charge: the exchange-traded fund or ETF and the robo-advisor. Think of an ETF as a single basket that holds hundreds or even thousands of different stocks or bonds. This simple invention has fundamentally democratized investing, allowing anyone to achieve institutional-level diversification. The growth has been nothing short of explosive, with trillions of dollars flowing into these vehicles. Zero-commission platforms and fractional shares have removed the last barriers to entry. Now you can invest for as little as $1. In a single transaction that takes less than a minute, they can achieve diversification that would have been unthinkable decades ago. The primary reason for this migration is the simple, brutal arithmetic of costs. Trying to pick stocks is an expensive endeavor. Mutual funds charge high fees, often 1% or more annually. An ETF might charge just 0.03%, $3 per year on a $10,000 investment. This cost difference, compounded over decades, can result in hundreds of thousands of dollars in additional wealth for the passive investor. Beyond costs, passive investing provides elegant simplicity and peace of mind. The stock picker is on a constant emotional roller coaster. The passive investor is liberated from daily drama. By owning the entire market, they accept the market's return, good or bad. The evidence is overwhelming. The vast majority of professional fund managers fail to outperform their benchmark index over any meaningful period. This shift brings undeniable benefits, but it is not without potential risks and drawbacks. A potential drawback is market concentration risk. As money flows into broad index funds, it's disproportionately allocated to the largest companies. The ease of access can encourage short-term speculation. The temptation to trade based on daily news can be strong, defeating the purpose of passive investing. How can a beginner harness these tools? The first step is simple: open an investment account. You can do this in minutes from your phone. You have two excellent paths: the robo-advisor route for hands-off investing, or the DIY approach using ETFs. The most critical step is making investing a regular, automated habit. Set up automatic transfers every week or month, even small amounts. Let me show you a concrete example: the 3-fund portfolio, celebrated for its simplicity and low cost. First, a total U.S. stock market ETF, 60% allocation. This gives you ownership in thousands of U.S. companies, from tech giants to emerging businesses. Second, total international stock market ETF, 30%. This provides crucial global diversification across developed and emerging markets worldwide. Finally, U.S. bond market ETF, 10%. Bonds provide stability during stock market downturns, acting as a valuable cushion for your portfolio. With these 3 simple ETFs, you have built a sophisticated, globally diversified, low-cost portfolio. This is the power of modern passive investing. It is simple, it is sensible, and it is available to you right now. The era of the stock picker is ending. The era of the wise investor has begun.